Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. So on the podcast over the last 3 weeks, you've had a couple of very large investment trusts coming on to talk to us in the form of Polar Capital Technology and Blackhawk World Mining. This week, we're going to the other end of the scale, so to speak, and talk to one of the smallest investment trusts that are out there, but one that nevertheless, I think, has some considerable interest for anyone who follows the sector. And that's partly because this trust, which is called Onward Opportunities, is one of the few that have actually been able to pull off an IPO over the last few years, an initial public offering. And more recently, this small trust has transferred from the AIM market to the main market and currently has a market capitalization of around 41 million. So those bald facts do, however, mask what's been a very exciting ride, I think it's fair to say, for this particular trust. It invests in smaller companies, UK smaller companies, and particularly AIM companies. Now, if anyone had said to you 3 years ago that this would be the ideal strategy to launch a UK equities small cap trust investing mainly in AIM, you would have thought that would have been a recipe for struggle. But this trust has battled on and survived and performed very well until the end of last year. And this year it's had another period of volatility. Share price has come down a bit, and we'll talk about that. But the manager of this trust is Laurence Hulse, and he is a relatively young manager in the sector. So starting out bravely to build a reputation and a viable long-term vehicle. So Laurence, first of all, welcome to the podcast. It's very good to have you on. As I say, it's nice to have representation from all kinds of trusts. Perhaps we could kick off if you just briefly give us your kind of emotional reaction to the first 3 years of your trust as a manager.
Good morning, Jonathan, and hello to all the listeners, and thanks for such a warm welcome 3 years into our journey with Onward Opportunities. You mentioned the launch and have asked me to reflect on the first 3 years. At the time, it was very modest. I think we floated with 12.5 million at our IPO. That was the largest IPO of the year in 2023 at the time, in the height of the Silicon Valley Bank run, which is when we ended up launching. It was described to me at the time by a colleague as a stake in the ground, and that very much was how it felt. That is how it's proven to be. But I think, and as you alluded to in your introduction, it's been a stake in the ground to really pin the tent down against some pretty strong headwinds and crosswinds at times. It feels like we've had a century's worth of global events crammed into the past decade since 2016, with the sharper end of that being in the past few years, whether it be Ukraine, interest rates, inflation, and more recently, the crisis in Iran. But we're very pleased to be here. We're proud of what we've been able to do for our growing cohort of shareholders so far. And we hope to be off that first stake in the ground, knocking in a few more tent pegs and growing the vehicle over time.
Perhaps you just remind us of your background, how you got to the point where you became the manager of a newly listed investment trust.
I started my career at Gresham House as a graduate about 12, 13 years ago now. And I was on the small cap equities team there, trained by and then worked alongside some well-known managers, many of which I think have been on this podcast: Ken Watton, Tony Dorwood, Richard Staveley, Brendan Golston. And that really taught me the day job of stock picking. And alongside that, rather fortuitously, because I joined Gresham House Asset Management at really its start in 2014-15. And for listeners that aren't aware or familiar with that story, Gresham House itself was an investment trust at one point in time. It went on to launch a series of investment products for clients, including trusts and companies. And when I joined in 2015 at zero AUM, it grew to sort of 7.5 billion before being acquired. And what that meant was I witnessed the team there build products for clients, build mandates, extend them, nurture them. Everything from Gresham House Strategic, which was on a sort of 35% discount when I started working on it, and when I left, traded at par or thereabouts and had done a good job for shareholders, all the way to things like Gresham House Energy Storage, Grid, which became very large mandates and products. And it was really the day job of stock picking and immersing myself and being around that successful discipline of building products for clients that gave me a sort of mix of skills to have. I like to call it bravery, but it might have been a bit bonkers at the time at sort of 29 years of age to resign from there to launch Onward Opportunities in what has been a tough UK smaller companies market, as you describe, admittedly probably even tougher than I expected. But we've managed to navigate that and deliver some returns and crucially grow the trust through a series of capital raises and trade at a premium. And it's been those skills I learned at that time at Gresham House that has enabled me to do that. And I will sort of be eternally grateful to all the colleagues there that took me from a graduate to someone today that's managed to launch and run a modest investment trust.
By inference, of course, this implies that you're probably in your 30s now. You're nodding at that. Therefore, you've got perhaps what I might call the exuberance of relative youth to carry you through this. What must be quite a torrid time. But it is noticeable that since the trust launched, most of the time you have traded around par or sometimes at a premium, sometimes just below par, and you managed to issue new shares, which is, again, something a lot of other trusts have found quite difficult. What do you think's been the secret behind that?
Premium discount is a function of a lot of things, but it is ultimately a barometer of the supply and demand for an investment company or investment trusts. Shares, we can't do much about the supply of those. If investors need or wish to realise their holding, that's their prerogative. But we can try and help generate demand, which is one half of that equation. And one of the benefits of relative youth is energy. And there have been some sort of long days at times traveling around the regions in the UK, sort of pitching the story in the morning and then catching up on the portfolio and the pipeline in the evening. And we like to think we've got a pitch and a strategy that appeals. I think we're starting to demonstrate that with both the performance, but also the fact there is demand for new shares consistently. And therefore, we put the time into spreading the word, getting the message out there. And look, being on Moneymakers today is an important next step in that journey. Very much until now, the shareholder base and the focus has been on regional wealth managers. We've had 3 or 4 TR1 over 5% in the trust now. And also sort of high net worth entrepreneurs, sophisticated investors. And we'll take a view on the slightly contrarian ethos of Onward, which is the UK market is very tough. So we're going to launch a fund. That toughness will enable us to capitalise on it, given the valuations it throws up. And we've been blessed with a sort of sticky, perceptive shareholder base that have put their money where their mouth is and bought into that and helped us grow a trust that's now sort of on its way, hopefully, to 50 million, where that can start to broaden out the conversations we can have and grow us beyond that.
As I said, I dare say the reason for moving to the main market was also related to that. It gives you slightly more marketability and so on. It opens you up to a slightly broader potential demand. Now, of course, UK smaller companies, there has been a very tough place to be, as we've said, but also traditionally it's been a very strong sector in the investment trust universe. Obviously, there have been struggles more recently. There is a wide range of trusts out there, even within this broad smaller companies category, to be fair. So what is it that you think you're offering that is different from what some of the other smaller company trusts are offering? I mentioned already that you have a particular focus at the moment anyway on AIM, but perhaps you could tell us how you interpret your mandate and how that differs from others out there.
I think one key point is definitely focus. Towards the end of my time at my previous employer, and more widely across the active management space, I think at times I've witnessed the risks of managers sort of drifting or pulled into areas beyond one fund or a couple of funds with very similar mandates. Even at 33, there are only so many hours in the day. Things like management responsibilities or wider, sort of higher top corporate objectives can eat into the time for managing the money or speaking with the clients. So definitely focus. My time is on Onward, and that's really what I live and breathe. I do think youth actually is a distinguishing factor. Whilst we've done a respectable job in our early years, we hope to keep learning and thus improving and subject to delivering good performance for the shareholders. we hope as a team to run this trust for a long time and therefore later on offer some consistency as well. Those are really the very sort of team-focused qualities. I like to think Onward's making itself quite accessible as well. Yeah, one of the reasons I opted to launch a trust or an investment company as this fund is in 2023 was I think they're great structures. And I think you described them as sort of London's best kept secret or the city's best kept secret. And one of the reasons for that, or their great qualities, is accessibility. There's no minimum investment like a private equity fund. Those are very in vogue at the moment. The minimum investment into Onward is the share price, which today is about £1.24, and anyone with a share dealing account can access that. In terms of the mandate and the strategy, concentration is the key point I would flag. I think certainly in a difficult market, as we're showing, that is a key lever to outperformance if it's done right. If you avoid the weaker or just doing nothing stocks in the index, of which there are many, and focus in on what we call the gems amongst the rubble, you can deliver outperformance for clients. And that's really the only reason Onward or any new trust should exist. There's plenty of funds already.
So you haven't perhaps quite clarified the point about AIM. I mean, AIM is a matter of choice, or is it actually, do you see yourself over time looking at other smaller companies that are listed on the main market, perhaps, or specialist markets rather than just on AIM? Is that part of the deal?
Definitely. I think AIM has offered a sort of microcap skew. There's lots of value on AIM at the moment. It's a particularly challenged market with all the uncertainty that's been going on around RHT and other technical factors. So the value has drawn the strategy there, but it's not a deliberate focus. Our objective is to find undervalued businesses below a market capitalization of 250 million. So that, of course, allows us to invest on the FTSE All-Share, FTSE Small Cap as well. And I would certainly expect more and more investments from that exchange too. Particularly as the fund grows, our strategy seeks quite concentrated positions and to be a feature of the top 10 of a target's share register. The larger the fund gets, the larger Onward gets, that opens up those sort of stakes in FTSE small cap companies, which tend to be a little bit larger on average than some of the AIM stocks we've been investing in so far.
So I mentioned it's been a sort of volatile ride, and that's to be expected, really, if you're investing in the kind of stocks that you are. Any kind of market panic or crisis is going to lead to markdowns right all the way down the market scale, and perhaps accentuated markdowns right down where you are at the moment. As you mentioned, the last sort of 18 months, I guess, have been particularly volatile, thanks mainly, but not exclusively, to President Trump. We had the whole tariff war. The initial phase of that was very difficult for you guys. You saw a big decline, which then bounced back at the end of second half of last year. And then again this year we had the Iran war, and that's also had an impact, been tough on a lot of smaller companies' shares. So is that just the price you pay for operating in the fields you are? Or perhaps do you have, I don't suppose you have particularly warm feelings towards President Trump at this point?
Look, microcaps are definitely a higher beta end of the spectrum of UK equity markets at the moment. Particularly the past few years, market makers are fewer and fewer, far between. They also have much tighter risk appetite on their books. So what you often see now in periods like the tariff war starting or the more recently the crisis in the Middle East is less liquid, smaller microcap stocks just sort of marked down on no volume day to day. And you've seen that twice now in Onward's relatively short history, both in the months of March last year and this year. And actually that March 2023 when we launched would be a third candidate where pretty indiscriminately shares are marked down. Last year we had, I think, 7 holdings down between 25 and 50%. This year around, our 2 largest holdings were down 50%, not just on no news, but they actually then came out to have good news more recently. So it just sort of highlights there is a higher beta, higher risk involved. It is the price you pay, but that works both ways like any exchange. Last year, we had a painful markdown across the portfolio, and then catalysts came through in the portfolio to recover that, albeit it was very much elevator down, escalator back up. But the NAV pleasingly ended the year last year at an all-time high, plus about 50% from launch in the 2.5 years before. We then had an even more painful Q1 this year, with the NAV down sort of 25%, if not more, in the first quarter of the year. But then, reassuringly again, we've just started to see some signs of another catalyst-driven recovery. Our largest holding, AudioBoom, has confirmed cash bid interest from numerous parties, and that's due to update this quarter. And the outcome of that interests are a potential catalyst there. We've had other holdings that are very UK focused manage to come out with trading updates. Things like likewise flooring is absolutely growing at socks off, same with RentGuarantor Holdings or Pebble Beach Systems, an international piece of software for the streamers and broadcasters, come out with ahead of expectations updates. Now, their share prices don't necessarily reflect that just yet, but they are sowing the seeds for recovery for the portfolio and the strategy.
And so if we look across your holding, you say you run a concentrated portfolio, perhaps inevitably, and I think your top 10 holdings account for about 2/3 of the portfolio, something like that, net assets. So are there any kind of particular themes in there? You've mentioned broadcast and streaming, new techie type of things, maybe software related. You've also got a property company, you've got a couple of, I think, industrial suppliers, those sort of things. Are you kind of focused on a few sectors, like, for example, Addition would be, or do you actually look across the whole space?
We look across the whole space, albeit we rule out a couple of sectors really because they are quite specialist and particularly binary. That would be sort of biotech companies or directly extractive resources. So think a kind of small cap copper mine or something. Now, in a concentrated portfolio in small caps, investment theses there tend to be reliant on one or two very large variables that make or break the whole thesis, if not the company. So we sort of exclude those, but beyond that, pretty agnostic. What we are consistently looking for is change in the business, and we take, where we can, a slightly contrarian lens or approach to change in those companies. So whilst that can mean there's a value bias or a special situations bias in the portfolio, at times, some of our best investments have been buying businesses on 1.5 times sales plus. Now, a value investor would probably balk at that, but actually it proved to be deep value because that business was then acquired on 6.5 times sales, which was Windward. Or in the case of AudioBoom, went on to trade at a much higher multiple through good operational execution. And now some bid interest, as I say. So it's the situations, it's what can be done that we're looking for. And I think that's where it is where the outperformance has come from, because as you're seeing from UK indices performance, just being cheap is scant. Businesses, their shares are really having to command capital. They're having to do things to drive interest or a re-rating and really grab what flows and fund managers' cash is around at the moment, because as we all know, unfortunately, there's a lot less than there used to be even a few years ago.
Perhaps I can tempt you into saying something indiscreet about the current government, because you mentioned a couple of times in your reports that you feel that the government has not been particularly supportive for smaller companies in a number of sectors. You talk at one point about the Chancellor confounding physics' theory of everything with a fiscal theory of nothing. What did you mean by that, and what does that reflect about your broader views about the performance of this government, which I think most people would agree, though they say they're in favour of growth, has not been particularly favourable to business?
So to pick up on the quote specifically first of all, I think what's been really frustrating is this sort of self-inflicted black hole commentary discussion that drags on for months with two budgets that were almost as late as possible. I think the one after the general election was the latest after election. And then 2025, they went as late as late November. Put subjective views on policy aside for a minute, we'll come to that in a second. Businesses love certainty, so do markets. I just think it's ill-advised to delay something as long as you can. It wasn't like there was some exciting rabbit out of the hat coming in the end. Both budgets didn't really deliver. And to therefore, it lends to the second part of your question. I think what's frustrating as a fund manager and someone that gives capital to businesses is twofold. The first is what I call the jawboning. Growth isn't summoned or invited to a round table, or more recently sort of commanded in the form of asking supermarkets to control some prices, or Andy Burnham talking about, I think, rent controls or similar. There's one thing that drives growth, economic activity. It has been incentivized. We've seen the opposite of that, and it's manifesting itself everywhere, whether that be London and the Southeast housing construction being at a kind of 2008 type low. That was supposed to be one of the government's big areas of growth, was house building. You're seeing it in consumer confidence numbers and PMI numbers. It's very frustrating to see what feels like basic A-level economics type mismatches going on. Everyone, I think, is cognizant it is not an easy situation managing the UK economy at the moment, or any economy, given what's going on in the world. But at times, you do sort of bang your head against the wall when you see things like the supermarket prices headlines. That is not the way to run a capitalist economy, and certainly not the way to grow it. The fact is, supermarkets are one of the most competitive industries in the UK with very, very skinny margins. The other frustration beyond the sort of jawboning is some of the policies. The fact that we have a record tax take already in the UK, and the answer again in the current sort of campaigning in Makerfield seems to be, well, we need to tax more and spend more, is difficult. And we see it live in our portfolio month to month. Some good examples last year. Angling Direct, one of our very first investments, one of the few retailers in the UK beating and upgrading profits forecasts. They managed to upgrade twice in their last financial year, but it would have been 3 times and a blowout result had they not had to absorb £750,000 of unexpected national insurance costs that, when the forecast was set 2 or 3 years ago, they did not know were coming. It's all well and good changing policy at the headline level, but this money has to come from somewhere. And in the case of Angling Direct, obviously, as one of the shareholders, one of the frustrations is what it might have done to increase the shares further. But actually, the real cost is they then decided to not buy a second or third automatic warehouse sorting device, which would have been more capital spend into the economy and so on. And there's lots of examples like that in the portfolio. I don't want to go on about too many today and turn it into a sort of Radio 5 phone-in moaning. But I think businesses need help and support and guidance and clear guidance. And it feels like at the moment they're just not getting that.
I think that's a fair point, I have to say, without getting political, as you say. I think that would certainly be a consensus view. They're not providing the incentives for growth that they perhaps would wish to have done. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth, independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Let's talk about a couple of things that you are invested in, which I find interesting. One of them I picked out was a company called Springfield Properties. Okay, now that's an interesting one. This is mainly a Scottish house builder and landowner, I think. Well, they have landowner in the sense they have a land bank. What's interesting about that? What drew you to that particular company? And what is it about the Highlands in particular that should get one excited in this particular context?
So with Springfield, it was a sort of twofold thesis, one of initial recovery and then some growth levers, which at the time when we invested were potential levers to reach for. But now, nearly 3 years into the investment, the company really is grabbing with both hands and pulling. The business had, I think, floated back in 2016-17 on AIM. It got off to an okay start. It's a Scottish house builder. It had gone on to acquire some other house builders using debt, and then COVID struck under the sort of lockdowns. And the business was very overgeared versus some falling earnings numbers and sort of other liabilities due. So the shares really did, as anything with a bad balance sheet has been in the past 5 years, were sort of hammered, I think from memory, about £1.50 to 50p. Now, the interesting thing with Springfield is the net tangible asset value of the business is about £1.50. And a large portion of that net tangible NAV is land with planning permission. In fact, before a series of disposals, which I'll come on to the moment, they owned, I think it was the largest bank of land with planning permission in Scotland and one of the biggest in the UK. We're probably all too familiar with the value of having planning permission in the UK. So only a very large bank of land with it we saw as an asset that was genuinely realisable and at somewhere around NAV, and the shares were about a 66% discount to NAV. The issue was the debt, but if you sold portions of the assets, you dealt with the debt. So we took what we call a nursery position initially because it was very geared and we had to actually see they could dispose some of the land. You never know till you know. The board and the management successfully started selling large portions of land to the likes of Barratt's at 1.2 times NAV, and that gave us increasing confidence to make it a core holding at near a 90p, having built a nursery position around 60. For the benefit of the listeners, the nursery is where our position starts off before we have conviction to make it a core holding in the top 10. So we try to match the conviction with the concentration. And as the business delevered, sold down land in a series of transactions over the past 2 years, it enabled time for the core house building business to start to flourish. And this is the growth latter part of the thesis. So there's a lot to like about building houses in Scotland. It has the best affordability rate in the UK. That's the sort of ratio of average earnings to price of house. There has been a clear sort of exodus from the London-centric home economy for office work that we had before the pandemic. You're seeing that in London house prices today. So we saw some good appreciation opportunity in the house building they did. Not only was it affordable, it could probably be a good area of the asset class. And most excitingly was post-pandemic, the UK's focus on free ports and a very large one being built in Inverness, which is the sort of old stomping ground of Springfield. They own a lot of land with planning permission around where that free port's being built. It's sort of not easy, but very clear to sort of deduce as a stock picker. You can spend a lot of time on SSE's website and the Highland Council's website and work out how much is being built and where it's being built. So Scotland, as the house builder in the area, owning a lot of land in the area, we expect to do well over the longer term. And fairly recently, about 2.5 years into our investment in the business, we were delighted to see the first of these homes being built specifically for the Freeport. What's particularly interesting to your question about why the Highlands, there's not many hotels near Inverness, but there is 10,000, I think, workers required in situ for the stated time is 5 years, but based on pretty much every other UK infrastructure project, we probably expect construction to take 10. Those workers need to be housed, and Springfield will build houses for the construction workers to live in and pay a rent. And then at the end, when the construction workers leave, those houses can be sold to new long-term residents around at what should be a real hub of UK economic activity. So, yeah, a good example of the sort of gems amongst the rubble going on AIM and UK small caps at the moment. A business with such quality assets that was trading at such a discount to NAV, and then to have this potential golden goose at the end, it's been a key portfolio case study.
I mean, that hasn't stopped the shares selling off this year so far. I mean, they're down, I think, about a quarter, as you mentioned. They're back to around 90p. But you think this is that's market dynamics rather than a change in the underlying proposition?
I think the house building angle for the private market of the proposition has definitely now been kicked out 18 months, because at the start of the year, I think most people expected 3 interest rate cuts, and now it's probably more likely we'll get 3 rises. But the Inverness Freeport part of the thesis, that stands regardless. SSE got their £33 billion fundraise away just before the Iran war started. Those are the funds required for this Freeport project. You can go in the appendix of their slide deck and see the different sites and when spades are going in the ground. And a number of those spades are hitting turf for Springfield this year. So that element of the thesis will stand, albeit the private sector part, admittedly, is definitely delayed now.
I was also your comments you made about AudioBoom and the fact that there looks like there could be some cash bids coming in for that business, which is, as you said, a podcasting support business. I suppose you'd describe it as a podcast management and consultancy kind of business. And you've also talked about the dynamics that derive from, on the one hand, relentless outflows from UK equity funds against the possibility of others, corporate, private equity, corporates coming in to pick up what are very low valuations in some cases. So there's a kind of two-way pull here. You've got demand still evaporating on the UK equity fund side, but you've also got the potential of others coming in and seeing the value in the proposition. So are there other companies in your portfolio where you might actually see that dynamic playing through? Obviously, we don't know where the bids for AudioBoom are coming from yet, but do you see that as private equity mainly, or do you see it as other corporates coming in?
I think a mix. We certainly expect the trend to continue. In fact, in the 2 weeks running up to recording this on the 26th of May with you, Jonathan, there's been a number of bids or rumoured bids come out. There's been a real pickup recently in the UK market, and it's because of that phenomenon you describe. Specifically on the Onward portfolio and what we've been seeing, we had one sort of premium takeout Christmas Eve 2024, which was Windward. That's the one that went on 6.5 times sales, and we'd been buying on 1.5 to 2.5 times sales just 18 months before. Again, those sort of gems amongst the rubble. With AudioBoom, podcasting is seen as a key part of the future of media. It's data-driven. The economics are very good. You can record content much like we are today, i.e. very low production costs, but still advertise at a premium rate, therefore creating a healthy margin for media businesses. That's why you've seen, I think it's 6 acquisitions in the sector since sort of November 2025, so in the past 6 months really. And it's why we're sort of quietly hopeful that AudioBoom may deliver something too. They have publicly confirmed numerous parties' interest, so let's see where it goes. But it's been big beasts like Netflix, Fox, making the acquisitions. So American buyers, corporate and strategic in nature rather than private equity. And actually across the wider portfolio, I think for some businesses, it's the way forward. It's increasingly hard to be small, and therefore the temptation for synergies and bulking up grows, if anything. And one of the key determinants of a transaction is the price at which it can be done, and that's suiting both vendors and acquirers. The longer the UK market stays at this relative discount, you just allow more time for more opportunistic transactions. It's why it's really important, back to your questions around the government and growth earlier on, we've got to incentivize, and that includes incentivizing companies to list and make themselves available to Joe public. I always find it very strange how a sort of Labour government of working people seems to provide better policy treatment to private equity, which is sort of exclusive and very hard to access for the traditional Labour voter. But as is the stock market, where anyone with some savings and a kind of ISA or JISA or SIP or whatever it may be, account on an AJ Bell, can access it. And I thought the Labour Party was all about accessibility, but there we go. And you've seen some interesting floats, a bit of a flurry pre-Hormuz in Iran, which is encouraging to see. The muscle memory still worked, and the same applies to the markets themselves. There was a bit of a re-rating story going on in January, February, and in typical British fashion, in a kind of World Cup final going to penalties type sentiment, just as things were looking up, the rest of the world had other ideas. But I think that's encouraging after a difficult decade for UK equities that the plumbing still worked and investors knew where to come. You were definitely seeing some re-rating going on at the start of the year.
One of the holdings I thought was interesting, you mentioned obviously the government policies not being helpful in some ways, but I noticed one of the holdings you have, about 5% I think of the portfolio, is a company called RentGuarantor, which I think you like because it's partly a beneficiary of some new regulations for renters, which may not be good for the UK economy overall, but could be good for your particular investment. Tell us about that particular story.
RentGuarantor Holdings is a provider of professional rent guarantees. Very common practice and business in America. There's a large business called The Guarantors that I think is worth about $500 million, common in continental Europe. In the UK, had never really taken off, and that's because there was a substitute, which was really friends and family could provide a guarantee in the form of paying some or all of a year's rent upfront to a landlord. So think students at university or leaving university, graduates, young people without a long earnings history. The Renters' Rights Act, one of the many externalities of that policy is that is illegal now. And it's designed to try and make the rental market more equitable, i.e. those without friends and family that can't pay upfront in cash, losing out on a desired tenancy or a property. So therefore, all of a sudden, Paul Foy, the founder of RentGuarantor, sort of spotted this coming down the tracks a few years ago when he set the business up. There is a need for professional guarantees, of which RGG provide. The business model is pretty neat and pretty simple. They credit check, history check applicants for a professional guarantee. They have a technical system that decides, from looking at bank statements and the like, whether someone would be a good renter to guarantee their rent for. If they do, those guarantees are then pooled and underwritten by an insurer. And it's a really attractive business model because the market is very large and has all of a sudden opened up massively. And I think you're seeing that in their recent trading updates and share price performance. And All of those were before the Renters' Rights Act actually started. So all eyes on that business this year. And if they can continue to deliver, they need to, they ought to, if the thesis is correct. But the business model works for both the customers and the suppliers. So the suppliers are the landlords. All of a sudden, it's much harder to evict a tenant in arrears. So the risk of a unguaranteed or poorly guaranteed tenant has gone up. So the landlords find this product very useful because it removes all the cash flow risk to them. And that's the key difference with landlords insurance, where you then have to go and claim, and there's a lag time and a lot of work involved, and therefore a sort of cash flow risk to a landlord. That doesn't happen with Rent Guarantor. They step in straight away and they deal with the insurers on behalf instead. And then, of course, the tenants. People need to rent more than ever because of house prices in this country. And being able to access a professional guarantee service, because other sources of guarantee are now harder to come by, is obviously of huge attraction to the tenants. And I think that's why you're seeing such a, I think they're forecast to grow at 110% per annum this year, albeit there's some law of small numbers in there to sort of sensitize that. But they came out with an update, I think in March, saying or implying they were already looking strong on that after Q1. So clearly the demand is there, and certainly one to watch in the portfolio. And again, an example of genuinely interesting business models that you can find on AIM and in small caps. And that's what Onward's here to do. We managed to put money into RGG at a market cap of 12 million. There's a scenario where the sort of investment multiplies and multiplies from that level. It's already capitalized at about 28 today. And I think earlier in the podcast, you asked me about how does Onward differentiate itself, or why does it exist? It's to find investments like that for our shareholders.
I guess my final question, which sort of wraps into a kind of outlook question, if you like. You've pointed out how volatile things are and how external factors can change things. Last year, you said that going into what turned out to be the tariff negative share price reaction, you actually had quite a lot of cash in the portfolio, and you said that was partly based on a kind of gut feeling that things were going to get worse in some way. And again, you've got a lot of cash at the moment, I think, according to your latest fact sheet anyway. What's the story around that? What is your strategy towards cash? And what does it tell us about what you think the risks and rewards for your portfolio are, the fact that you've still got quite a significant holding of cash at the moment?
One of the functions of a growing fund, a growing trust, one that's been particularly sort of fast growing in percentage terms like ours, has been sort of inflows of cash. An investment trust structure is the purest stock picker's approach, because you aren't buying and selling stocks based on inflows and outflows on a daily basis. You pick the stocks and you buy and sell them when you think the price is right. So when we've had cash coming into the portfolio, we haven't just lazily, or worse, sort of just bought what we've already got across the portfolio blanket and sort of kept the weightings the same. We've intentionally let the cash build up, and where possible, or preferably, we've deployed funds into new ideas to add diversity of return for all the shareholders, to make sure we're not diluting what have generally been good entry prices in the investments we've already made. And I think it adds to the story of the fund growing and deploying capital into new parts of the market, new investments. It has meant that the portfolio has evolved quite a lot in our first 3 years, because if you think the fund was 12 million and now it's 42, unless we had just bid up and paid higher and higher prices for existing holdings to maintain their weighting, naturally some have diluted down or away, but that has made room for new ideas and diversity of return. In terms of sort of risks and reward factors around deployment of funds and the existing holdings today, I think the big risk remains politics, both globally and actually domestically. Now, if we had to flip a coin today, my bigger fear would be Burnham rather than Donald. I think it might hit peak Donald, but let's see. Because comments like hock to the bond market and make capital gains tax the same as tax on work, whether they do these things or not, just talking about them, you're seeing it in things like gilt prices already. And by the way, gilt prices or interest rates, because we have quite a lot of floating rate debt in the UK at the government level, I think we spend more on interest than defence. So it's a pretty big variable for Rachel Reeves and conjuring black holes again. I remember back at school doing things like PSHE, I think they called it. And we learnt a varying degree of useful things. Some things like the Green Cross Code were probably quite useful. But then I think about other things we spend our time on, versus the general population's understanding of economics and why we are in the hock to bond markets, because it is other people's money that we spend, it's quite dangerous. So I think the big risk for all portfolios and just investors in the UK is how left Labour have to go to respond to reform. It doesn't look like they're going to try and meet them in the middle. And there's nothing we can do about that other than focus on what we can influence or control, which is catalysts in the portfolio, focusing on areas of global growth or global earnings in the portfolio. I think you had Stuart Widdowson on the other week. I was really impressed to hear how I think just 20% of his portfolio's earnings are in the UK. And I suspect at the very high level, that's why his trust is having a good time of it at the moment, because the global economy, especially America, is performing very well. Rewards, similar theme, other side of the same coin. We've had 3 takeouts in the portfolio so far, and there's speculated interest in our largest holding at the moment. They've all been global businesses. I don't think that's a coincidence. If you're in a sort of Wall Street or Houston or Los Angeles boardroom and you're working out how to grow next to your next source of earnings, one of the options is you can buy some global market share at a London multiple. It's a pretty compelling payback story. So I think rewards will come from international investor interest, whether that be in the form of sort of M&A, or actually what we saw in January, which was this first trickle of reallocation to Europe and the UK from US and global investors. I think one of the very thin silver linings of the clouds over the Strait of Hormuz and Pennsylvania Avenue at the moment is a bit of a reality check on, yes, the UK economy has been on a monster run and has warranted a premium because the rewards are there. And they're still, by the way, I think US earnings growth outside of a kind of post-war or post-crisis recovery period is the best it's ever been, as someone on Bloomberg TV was saying last week. The rewards are definitely still there. I'm not here trying to sort of crow that the UK economy is about to outshine the US. But what I think has happened is an investor's risk matrix is 2 things, reward and risk, and balancing the 2. And I think it's hard not to argue that in the sort of Trump era, populist era, the risk element has dialed up, and therefore there is some diversification going on. And there definitely was in January, February. We saw it firsthand. For the first time ever, we were having international investors call us up about something we owned, or actually joining the share register of something we owned. And I think that's an area of reward. And again, back to your question earlier, the jawboning and the commentary from the government. That's why it's so important. The UK in a parallel universe could be a real safe haven at the moment, where it's rule of law, statute law in terms of business and economics, a market that was cheap but hopefully would have got expensive by now in that parallel universe. Predictable, reliable, and value. That would have been a really compelling combination, and still can be. With some small tweaks and a bit of plain sailing and political stability, the UK market looks right for an investor that doesn't want to go too far into emerging markets, but wants to just add a bit of diversity of return from their American portion of their portfolio.
Well, let's hope that we get a return to January, February conditions then, maybe as the Straits of Hormuz issue is either resolved or at least left unresolved, but doesn't get any worse. And we'll hope that that turns out to be another good period for your own trust. So thank you very much, Laurence, for talking to us. It's been very interesting. It makes, as I said, a nice contrast to some of the other conversations we've had recently. And we'll look forward to following you with interest to see whether the early promise that we saw up until the last few weeks continues to be delivered. So thank you very much.
Thank you ever so much for having us on today, Jonathan.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.